were a couple times though where it wasn't that, and in
That's
both
right.
those instances, what happened?
World wars.
Yeah.
Yeah. So if we have World War III next month, then maybe the real estate cycle won't be 18 years.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour our old fashioned real estate advice.
Episode 13.
All right, welcome to the Old Fashioned Real Estate Show. My name is Brian Leverage, and this is
Jeffrey Holst.
And we're glad to be back with you guys again today. We're going to talk about something that Jeff is very informed about, and he looks forward to sharing all that information with all of you, and that's the real estate cycle. So take it away.
Yeah, so this is something that I think about a lot because it's real important, especially at this point in the market cycle. I mean, I've heard from a lot of real estate investors. I should clarify
what
today.
What is the cycle?
Yeah. So right now it's we're in May of 2019. If you watch this video 3 years from now, obviously we'll be at a different point in the market cycle in 10 years from now and whatever. But in May of 2019, that's when we're filming it. So the real estate market cycle in a simple version is that, you know, real estate prices go up and down over time. Mm-hmm. That's essentially what it is. And a lot of investors today are thinking about the fact that in 2006 prices were very high and in 2010 prices were very low, and a lot of people lost their money. There was a lot of foreclosures that took place, and so now several years after the recession, people are starting to worry about when that next market cycle will occur. We have a whiteboard down here and we've knocked it over.
Yeah. So there's about four segments, right?
That's
the
right.
Cycle. Do you want to go into a little detail?
Yeah. So before we do that, I want to talk a little bit about the length of the cycle. Actually, so a lot of people say different things, and I hear people talking about how there's a 10-year real estate cycle and we're overdue for a correction, and I hear people saying that there's a 7-year real estate cycle, and there's arguments for all of this stuff. But if you look at the actual science behind it, the economic theory, and you look, we could get into a lot of economic theory, but one person I like in particular is Fred Foldvary, and I'll make sure in the show notes I link to his article. But he wrote an article back in 1997 called The Depression of 2008. And in that article in 1997, he predicted the 2008 recession exactly on point.
Right.
And what he did is he used a combination of historical data and economic theory to predict that. And he looked at all of the previous real estate cycles over the last 200 years, all the way back to like 1818.
And what did that information show?
It showed that the real estate cycle generally is an 18-year cycle.
Okay.
It tends to be exactly 18 years. It doesn't tend to be 17 one year and 19 the next. It tends to be 18, and there's a lot of reasons for that.
And there were a couple times though where it wasn't that, and in
That's
both
right.
those instances, what happened?
World wars.
Yeah.
Yeah. So if we have World War III next month, then maybe the real estate cycle won't be 18 years. I mean, again, this is historical data, so there's always the possibility that it's wrong. So it's really important to look at the market cycle chart that we're going to share in a few minutes to decide it. But I'll actually put up a graphic just now, and you can see it here in the air or somewhere, that shows the real estate land peak cycles over an 18-year period. Oh no, that's not the right one. This is it right here. So I've got it here, but we'll try to put it up in the air there. This is not the first episode we filmed today, so it should be a little bit more fun.
Yeah.
Anyway, so charting the real estate cycle over an 18-year period, you'll see by looking at that graphic that the only times where it was different than 18 years were during World War II and during World War I. And then,
but not in that order.
Well, correct, yeah. And then immediately following World War II, there was actually a really long cycle.
An extended.
Yeah, and then it took a little bit of time to reset, going up until 2006. But when you get to 2006, if the real estate cycle is in fact 18 years again, that means that the next cycle might not peak until 2024, right, which is still 5 years in the future. So now we can talk a little bit about the whiteboard that Brian's already...
We're high tech here.
Yes,
we're very high, real estate
very
show.
high tech. So this is what the real estate market cycle looks like. Okay, so this is a really interesting thing. So you start down here in recession, and you move up into expansion, and then ultimately into a period called hypersupply, and then down to recession, and then right back to recovery. Okay, so it goes recovery, expansion, hypersupply, recession. So now what's really interesting about this is what these lines mean. So this horizontal line here is long-term average occupancy, and that's market dependent. It's also asset classification dependent. So let's say we're talking about apartments in Chattanooga. Okay, so that's something Brian and I are particularly interested in because we like apartment investing in Chattanooga. So if long-term occupancy, and we're talking about 20, 30-year averages, we're not talking about 1, 2, 3-year averages, okay? Right. So if the average occupancy, and I don't know this number, I probably should, but let's say it's 95% is the average occupancy for apartment complexes in Chattanooga. All right, and you can drill down even more, like B-class apartment complexes or C or A class. And what you can do is you can look at that and say, okay, so if we're above average occupancy, then we know we're in phase 2 or 3. If we're below, we know we're in phase 1 or 4. Mm-hmm. Okay, and then this line here, the vertical line, is the direction of occupancy. So this is the occupancy line, and then you can see as it crosses the peak, it starts to go back down, and then as it gets over here, it starts going back up. So you know if occupancy levels are raising, you're in either phase 1 or 2. If occupancy levels are falling, you're in either phase 3 or 4.
This is a great time to buy, right here.
Well, yeah, I mean, and actually 0.5 is the best time to buy, right?
Yeah.
Where occupancy levels are going up and they're about to cross over the long-term average. Because what happens is when occupancy levels are above long-term average, rents start going up.
Yeah.
Right? And what happens when rents start going up is new construction starts coming online. People start saying, hey, rents are going up, there's money to be made. And so people start constructing stuff. And you know what? Even when occupancy levels are falling, but they're still above long-term historical occupancy, people are still constructing stuff.
Right.
Okay? And that's how you get into hypersupply, right? So what really happens is over here in recovery, the economy's starting to get better. Occupancy levels are starting to go up. It might be like 90% down here, and then it's 93%, 94%. But at 94%, if you bought back here somewhere and you modeled your apartment complex based on a 95% occupancy, I'm gonna let you hold that.
Yeah.
So if you modeled based on a 95% occupancy and you're at 93% occupancy, you're not raising rents, right? You're maybe lowering rents, but you're definitely not raising rents.
And right now, from all the data that I've seen, and I know you've read the same stuff too,
Yeah.
because generally he emails it to me first, is we're in phase 3 in the majority of markets. Are we
Yeah,
not?
I think that's right. And it depends a little bit on the asset class. So for apartments, I think especially on the coast, we're definitely in phase 3.
Yeah.
Some markets are maybe as far as right here at 0.14.
Hello, Oklahoma City.
That's right. Oklahoma City is 0.14 according to the data that we've been reviewing. But some markets like Metro Detroit are back here in like 10 and they're still in expansion.
Yeah. Which means you still got plenty of runway in front of you.
Right, yeah, you don't want to buy right here because this point, 0.14, is where occupancy is falling and it's at the long-term occupancy rate. So now, in fairness to Oklahoma City, it's been at 0.14 for 2 quarters now. Might still be there for 2 more quarters. We don't know.
Or maybe another couple years.
Yeah, but if it falls below the long-term historical occupancy because people are building more than the demand is building up, then what's going to happen is rents will start falling. And that happens that minute. So this is the peak of the market. Most people think when they look at this chart that the peak is up here at 0.11, but in reality, it's right here the day before recession. That's the peak of the market. You don't want to buy there if you can help it. Now, I will say one little caveat on that. If you bought at the peak of the last market, which was 2006, and you were selling today, you're fine. Because the market doesn't go down and then back to the same point. It goes like this, and then it goes down a little bit, and then it goes up a little bit higher, and then it goes down. You know, so it kind of ratchets up. So what happens when you do that is, if you're going to buy today in Oklahoma City, you better make sure that you have good cash flow so that you can continue to pay your mortgage payments. And you better make sure you have
strong reserves.
yeah, strong reserves, so you can have your property be the best property in the market, right? You can continue to provide.
And you can weather the storm.
Yeah, amenities and stuff like that, and keep your occupancy level as high as possible. Because, well, average occupancy might be 92 or 91 or 90%. That doesn't mean your occupancy has to be that.
Right.
And so having good amenities is important. Having a quality property, keeping everyone happy. And
Good
also,
property managers.
that's right, having good property managers. But also, I think it's really important to recognize that if you don't have to refinance in a recession, and you don't have to sell in a recession, and you have enough cash flow during the recession, you can survive the whole deal, like you said, weather the storm. So that's kind of what happens. So I'm going to just take through the 4 phases real quick, and then we're going to wrap up, because this is a topic that we could talk about for 2 hours and not cover all the variables. So recovery, right? This is 2010, let's say, right? That's when the market started to tick up, but rents were still really low. Occupancy was still really low, but it was starting to climb. Expansion is the phase that we're either in or just coming out of right now in most markets. And it's different, by the way, with, like, say, office buildings might be down here, and apartments might be here, and single-family houses might be here, right? I mean, I'm not saying where individual ones are, but you can buy this data. There are companies that will actually track it for you. And you can also, if you have a big enough portfolio, you can calculate this data yourself.
Yeah. Well, a lot of times, just a newspaper subscription to the local market will help in that. Where we're at, Chattanooga, Tennessee, for instance, there's a lot of A-class new construction apartments in the downtown core that have been built in the last few years. They've been suffering with occupancy issues for about the last 18 months, give or take. So
and they might actually be down here, right?
Right.
So brand new construction, and there's something to be said about this. When rents are going up, even at 0.13, 0.5, people are still starting new projects. Right. And we're seeing that in Chattanooga. People, even though there's occupancy issues, people are still starting new construction projects. And it's because rents are still high. And the problem is that these things take a couple years once you start it to finish. And so when you get down to recession, you've got more new supply coming online, and you don't have any demand. And so you're having an even deeper and deeper recession. And that's really why 2008 was so bad, because they had encouraged construction by doing a huge amount of tax cuts and tax incentives and cheap loans. And the cheap loans are a big indicator of a pending recession. Now we're in a weird situation now where we've had super cheap loans. I think we can put that away. I think people understand that. Super cheap loans for a decade now.
Right.
And that might change the market cycle. So it's possible that even though it's typically 18 years, that we'll move into recession in the next 12 months. Some people are predicting that. I personally have a lot of faith in the 18-year cycle, and I think that we have a few more years to go. But that's sort of the market cycle thing. It's dangerous to try to time it, though. So I think what we were talking about being able to weather the cycle is really important.
It's a long-term play. Don't look at it as short-term. When you go short-term, as Joe Kennedy said, pigs get fat, hogs get slaughtered.
Was that Joe Kennedy?
It was.
Wow. We're going to have to verify that and make sure Brian's not
Bang
just...
it.
All right, fair enough. I think it was Joe Kennedy that had my favorite axiom of all time, actually. He said that he sold out of the stock market, because he was getting his boots shined, and the boot shine person was saying about all these stocks that he was borrowing money to buy stocks on margin, and he said, "Okay, cool, that's great for you." And then
kids giving me stock.
Yeah, and then he immediately walked out the door and sold everything out of the stock market right before the crash.
Yeah.
Are you sure?
Positive. I forget his name.
I think that was it might have been J.P. Morgan.
We'll
put that in the show notes. All right. Well,
thanks for joining us today. That's all we got for now. We'll look forward to seeing you again in the future. Have a great day. Cheers.